Hi, I'm Helen Bullick. I lead Craig's Specialised Wealth Advisory team.
Hi, I'm Vanessa Stevens, and I'm a Senior Sustainability Analyst within the Private Wealth Research team. Today we are talking about the different approaches to sustainable investing.
Because sustainable investing is grounded in our values, there's no one-size-fits-all approach. That's why it's helpful to think of your options for sustainable investing on a continuum, from traditional investing to impact investing, in what's known as the sustainable investing spectrum.
On the far left of the spectrum, we have traditional investing. Traditional investing is primarily returns focused. Investments are assessed and chosen for their short and long-term financial return prospects. Through this approach, there may be limited or no focus on how investments impact the environment or society, or how the company will adapt to a changing world.
As investors apply values considerations to their portfolios, many people move on to screening. Exclusionary or negative screening can include identifying activities or industries that you don't want to invest in and excluding them from your portfolio. Common focuses of negative screening include alcohol and tobacco, animal welfare, gambling, armaments, and fossil fuels. On the flip side, there's also positive or best-in-class screening that identifies investments based on desirable ESG criteria, such as being the best operator in a sector.
One of the most common ways sustainability is incorporated into portfolios is through ESG integration, which is the consideration of environmental, social, and governance, or ESG factors, in the investment process. ESG integration involves looking at a range of non-financial measures, assessing the materiality of that information, and incorporating it into the investment decision. This is where the output of our Craig's sustainability framework can help.
Incorporating ESG considerations into an investment portfolio can help drive positive change by signalling to companies which areas stakeholders see as important and where certain issues may need to be addressed. Interestingly, incorporating ESG considerations can help to reduce risk in the portfolio. Companies with unsustainable business models can present additional risks to investors over the long term. Considering non-financial measures can help investors to manage risk and avoid investing in companies that may find themselves involved in controversy or facing a declining revenue outlook.
Beyond ESG integration, some investors choose to put their dollars to work in sustainability-themed investing. Sustainability-themed investing is where clients seek out growing industries that are set to benefit from medium to long-term trends. Examples include the move to renewable energy to combat climate change, or the shift to a more circular economy.
And impact investing takes all of the previously mentioned methods a step further, with investors specifically directing capital towards companies or projects that can demonstrate measurable environmental or social benefits in order to drive change. Impact investing is the most challenging part of the spectrum to implement. The local impact investment ecosystem is in the early stages of development. Not surprisingly, many community-based organisations and charities are focused on key societal issues, such as affordable housing and addressing inequalities. The ambition is there, but the avenues for investment are still developing. There are some great initiatives underway, with the community trust sector leading it. These initiatives will help to set a blueprint to follow and inspire others to increase their impact.
Your investment advisor is here to help you consider your own approach to sustainable investing and craft a portfolio that matches your objectives, circumstances, and values.